How would you like to know the opportunity cost of buying in the wrong location? Hi, I'm Jared Krause.
And I'm Sam Powell, and we're the hosts of the Property Pals Australia podcast. And in this episode, we are going to be discussing the importance of finding the right location, the opportunity cost of getting it wrong. And I talk about this in the podcast. We reference 10 years, but it's 20 years. And there can be a potential opportunity cost of $900 to $1 million over a 2% differential growth rate in your asset selection. So really key to understand. We also jump into what data you need to check to find the right location, like the supply and demand metrics and why they are important with things like vacancy rates, land supply, risks, gentrification, and more things like that. So listen on in.
Yeah. We also listed like a bunch of resources that Sam knows, listed out names and places you can go to find all of this data and do it yourself if you do want to do it yourself. We listed out so many different other things other than what Sam just mentioned in the vacancy rates and land supply. Like Sam is a great knowledge resource on this as well. So there's a lot in there. We also talk about why you are responsible for your investment, even if you are using a buyer's agent as well, and why it's important for you to know some of these metrics to fact check before you make the final approval. Like, yeah, this is a good location to buy in.
It's your money, your call.
Exactly. So this is such a valuable episode. Sure, you guys are going to love it. Let's dive in. Welcome to Property Pals, the podcast where we share everything around how to build a property portfolio, from researching areas, financing, structuring, buying, selling, and reinvesting to live a life of financial independence. As a disclaimer, any information shared by myself, Jared, Sam, and the Property Pals team is strictly general and should not be taken as constituting professional advice. You should consider seeking independent legal, financial, and taxation advice from a qualified professional. Welcome back to another pod, everybody.
Hey everyone, hope you're all doing well.
Yeah, hope you're doing well and you're ready to buy some properties here. We got so much to speak about in this pod on locations.
Mm-hmm.
I know a little bit, but not enough to be dangerous, and you know enough to be super damn dangerous. So teach me something on this.
Well, yeah, that's what we're here about. The education, legal education. So locations, what makes a good one? That's your question.
That's my question to you.
Yeah.
So I know there's a few things that I would like in my last couple of properties that I knew that I needed to have as a bit of a criteria on location.
Mm-hmm.
But there's so much in it actually, and you rattled off so many things. So when you realize, all right, I've got borrowing capacity.
Oh, that's where the confusion starts.
Well, yeah. Well, guys, if you haven't got our borrowing capacity, how to increase your borrowing capacity resource, make sure you get it from their site, propertypals.au. Get that. And once you realize what your borrowing capacity is and you've got that maxed out, and you're like, all right, I need to buy somewhere. So you got your location, and then you also got that property in the location. And we're going to talk about the property in the location and how to choose the right asset after this pod.
Yep.
After this episode. But once we've got our money, we're like, cool, I've got, say, $500K. How do I, or where do I buy? What's the starting point?
Yeah, so look, it's common confusion. So a bit of coaching comes into this part with people, and the biggest thing that I look at is the opportunity cost. So when I was starting my investment journey, it was like, fantastic, I've got $500,000 to spend. Where do I spend it to increase my return on investment in the short term, the medium term, and also long term, right?
Yep.
So you have there's over 15,000 suburbs in Australia.
Is that all?
That's all. So where do you start? And from the location perspective, you just work your way down. So there's a lot of different data houses that are out there that are really great at analysing the Australian property market, all the way down to a suburb level.
Okay.
But the key for me is finding the location, like the local government area. So that's like say we're in the Gold Coast here. That's the Gold Coast City Council local government area. If you're in Brisbane, it's the Brisbane City Council local government area. So they're quite large, and they're really like all the ABS data and everything like that point you towards certain locations. So you're looking at different demographics. You're also looking at, I guess you're getting a little data nerdy at this stage.
Yeah.
But for Joe Public,
yeah,
that's way over your head, right?
Correct, because that's where I start to tune out.
yeah. So there's heaps of a lot of say buyers agents. They tout themselves like this is their bread and butter. Like they know where the next hotspot is, and that's what's getting everyone's attention. This is probably going to be a controversial little pod, maybe, but I mean,
good, because I think what most people, this is like the big question that everybody's got once they've got money or pre-approvals. Like, all right, where do we go?
Yeah, so
controversy is good, so you guys can make up your own decision on where to buy. So yeah, how do we do it? Like what? So for Joe Public, for the average Joe, you've got 15,000 suburbs. How do I narrow it down?
Well, you can do it yourself, or you can lean on a professional to do it for you. So obviously, working in that industry, there's a lot of the buyers agents, specifically on the investor front, are generally in very similar locations at any one time, because that's where the data's pointing them. So you can get a lot of free resources by going to certain buyers agents' websites. They might have hotspots. There's also a lot of different data houses, like businesses that specialize in just analyzing locations. So just for an example, like Terry Ryder at Hotspotting, he releases a quarterly report for different growth suburbs for certain price points, and that's what he does every single day. So he's really good at picking those types of locations based on the data. There's also another gentleman, Kent Lardner from Suburb Trends, and he's massive amounts of experience. He used to work for CoreLogic and Pricefinder, trying to analyze locations, and he's built a business off the back of that.
Wow.
Then there's many more than that. So there's different websites, suburbsfinder.com.au. They're membership-based. Hashtag Analytics is another one that you can look at, sort of the data side of it, and also Jeremy Shepherd from DSR Data. They're membership-based websites that range from, say, $60 to $250 a month. But still, you're going to be getting a whole bunch of data which could get lost in.
So maybe we should get some of these guys on the pod, actually.
Yeah.
Shout out to everybody. Guys, if you guys want some of these guys that we've mentioned on the pod, let it be known to us so we can take screenshots of the emails or the comments that you send to us, and then put them in the inbox of these guests as bait to get them on the podcast, basically. So, all right, there's all these places that I can go to. For me, I kind of go, look, there's people that have a whole education and a whole career around finding the right location. I typically go to a buyer's agent, and we'll recommend some buyer's agents as well, guys, later on in other pods and stuff like that. But what are some of the things that Joe Public should be looking at once they've got, like, even if they go with a buyer's agent? What are some of the things they should be thinking about, or at least knowing is good to be looking at? Like, what are these data points that we should be?
Yeah, so I got a bit of a tangent on that one. That was a bit of free education, but I guess check out those people that I mentioned if you want to go ahead and do it yourself. There's a lot of great information there, and at a low cost too. But generally, from the location perspective, you're looking at, to find those locations, you're looking at things like days on market. You're looking at, like, basically the supply and demand levels as the overarching principle of it. And then also going further into, well, what's the future plan for this type of location? So by that, I mean, you're looking at what the future development potential is for that whole local government area, what the infrastructure spend is going to be, and why there is prospective growth going to go through that location. And as an example, there is a inland rail that's been approved in Australia. Some people know this, some people don't. That's connecting basically Queensland down to Melbourne. And there's a lot of those regional towns that are on the outskirts of that are going to be great beneficiaries of all that infrastructure spend and connection for people throughout Australia.
Mm-hmm.
Places like Albury-Wodonga, Toowoomba, as an example, they're on those near those stations, and that's going to help with all like the logistics and also people travelling. So things like that are really important.
Okay, you just did people a massive favour. You just dropped 2 locations.
Ooh.
This is what people are coming here for on this pod.
Well, the secret sauce for me is
guys, by the time this comes out, it might be a different area.
Yeah,
as well.
yeah. They generally change every sort of like 3 months or so, 3 to 6 months, and like say Toowoomba, for example, that's come off like a really low growth period over the past 10 years. So generally, locations, if they've done nothing, it's kind of like investing in the share market, right? If you're into those, like looking at the charts, if it's done nothing for a long period of time, there is like, well, what's the chances of it doing something in the future? And that's when you look into that data point and you can see.
Okay, so there's these different resources that you mentioned before, and you mentioned a bunch of things like your government area, population, days on market, all that sort of stuff. Like, what's the nitty gritty for somebody who's like, all right, 15,000 locations, 15,000 suburbs. You've mentioned 2. How did you get to those 2?
Okay.
What's the data that you saw that we should be looking at to find those? Like, it's How do you just go from 15,000 locations to like maybe 10?
Yeah. Okay. Well, you start narrowing it down. So this is where the data point, you're going to have to go into your back pocket, spend a little bit of money to get the data, which is fine. But the key areas that I like to look at are days on market, so having below 60.
Okay, below 60. Cool, yeah.
60.
Below 60 days.
Yeah.
Why below 60 days?
Because it's showing that there's a reasonable amount of demand. Properties that are taking longer than 2 months to sell, it's just an indication that there's not a lot of demand in that area, and that's there's this. I mean, you can go more risk averse and try and find locations that have done nothing. And for me, you're kind of taking a punt if you're going over that. And to each their own, right? I'd rather invest for the long term and have good confidence. So that's why I say 60
makes sense as well. If something's over 60. I guess I'm thinking about comparables, which may actually be a bit different. So once you find all those, so you narrow down to the suburbs that have an average of below 60 days on market, and then you narrow it down further, right?
Yes, that's one of many. So
that's one of many.
The key
what's the next one that's going to narrow us down?
Well, that's getting into like the buy demand levels. So you can see, like, I aim for average to high buy demand levels, because that's obviously showing future growth prospects because people are flooding into that area.
And how do we know what average to high looks like in terms of an actual number?
So that's coming into the days on market, and then the inventory levels. So inventory levels are basically how long are the properties that are on the market going to take to sell. So for me, I've got like a bar of I want to try and make sure that if all the properties that are on the market today, if there was no more added, they would be sucked up within 3 months.
Okay.
So that's the goal for me. And any above that, then you're going into, it's just like you're going high days on market and things like that. So the demand level is not as high.
Okay.
Like you got to put a line in the sand somewhere, and for me, that's where my comfort level is.
Okay, average to high inventory level.
Yeah, so inventory level 3 or below.
Yeah,
below 3 is probably the real target. So below 3 months to basically suck up all the inventory that's in that suburb. And another key area that I look for locations is population. So
yes,
50,000 people is my absolute minimum.
50,000 people in that location. And how in how big of an area?
So that's the local government area.
Local government area. So, all right. So that's like basically the Shire.
Yeah. So say Toowoomba at the moment, that's 125,000 plus.
And why no minimum of 50,000? Yeah.
Yeah. Good question. And ones that comes up.
Is that because of the demand?
Well, just
Like
it's
it'd be harder to
diversity.
sell and stuff if you need to, or
Yeah, diversity of employment. So if you've got too little people, then like population growth compounds, right? So
yeah, it's not going to grow as
it's not
fast.
going to grow as fast, but also like for me, those locations that are under 50,000, you're going into too regional, and in the event of a pullback in the market, which often occurs, it's generally, I mean, every 10 to 18 years you have a deep pullback. Like you look at in 2008 we had the GFC, right? And then in 2000 we had the dot-com bubble, and then we had the 90s recession. You keep going back through time, and there's multiple
Pullbacks.
Multiple pullbacks that last, say, 2 to 4 years. So that's how I invest, because I'm more risk averse, and I'm not going for the home run where you go and invest in. I mean, Gladstone at the moment is on a few people's lists, but Gladstone, in 2007, people were flooding in there because they were getting 12% yields, and
because of the
mining boom. Yeah, correct. So and then
same thing happened in WA.
Yep, exactly. So those places, obviously, it's been 15 years now. So there's a lot of fear around those locations because of what happened. However, they've also gentrified, they've changed, population has gone up. So, and that kind of leads me to say, like 50,000 people, you've at least got a number of different employment hubs. So it's not just a mining town or a farming town, so to speak. So that's the metric there. The other thing which I just jumped on was the gentrification part.
Yeah, gentrification. So I didn't even know what this word was up until about 2 years ago. And especially where we live on the Gold Coast, it's like definitely becoming gentrified. Like it's harder for people to live near the beach because of cost of living. So do you want to discuss what gentrification is? And
it's a big, long, fancy word. Makes people sound smarter, but it's really just places moving from a lower socioeconomic to a medium to high, essentially. So that's the change. I mean, there's probably a more accurate definition you could Google, but that's how I see it anyway. Because, say, everyone who's listening to this, areas in your vicinity where you're like, oh, that's the ghetto, right? That's a bit of a we don't go there because we probably get sold.
Which is where I live now used to be a ghetto. Like it used to be very rough. So is that beckons the question, we're not going to go and tell people to invest in the ghetto, but like, how do you know when to invest in somewhere that's up and coming, or like what do we need to be looking for with gentrification, and what sort of data points?
Well, it's kind of common sense for me, really. Like the public housing levels are something to definitely monitor. But
so how many establishments are public housing?
Yeah, how many people in that, say, suburb are living in houses owned by the government?
And what percentage would you want?
I say 15 or below. 15. Below 15 is the key, and that's pretty high. So it depends on your risk appetite, but different price points too. Like if you've got a maximum budget of $350,000 and you want to buy an established house, you're going to be looking into locations that do have good public housing. It's often not a place where you want to live, but you're investing to make money, and for those price points.
And some people may actually, for where they can afford rent, and that's the location that is right for them, based on where they're at financially.
And it fits their brief. If they're looking for cash flow or to increase their portfolio, they need to have assets that have a decent cash flow component, because when they go again to build another property, banks are going to look at, well, what's your cash flow? If it's negatively geared, your cash flow is going to be basically telling the banks that you don't have enough money to service a future loan.
You basically own a liability, not an asset.
Yeah, well, it's increasing in capital value. However, the cash flow component is, it's going to hold you back from number 2 and 3, and like
borrowing capacity.
Yeah, borrowing capacity wise, and
hint, hint, wink, wink, nudge, nudge. Get that resource, guys.
Oh yeah, how to maximise your borrowing capacity. That was good. So where am I? Gentrification. Yeah. So
is there a cap? Like you say, no more than 15% public housing. in an area. But if there's like no public housing in the area, does that mean just don't go near it?
Oh no, it's gravy.
Okay, cool.
Oh,
Thought
good.
so.
Gravy means good.
Not if you're allergic to gravy like myself.
Gluten free over here. But so common sense. Like if you're looking at an area that's got high public housing level, but all around it is low public housing, that's that gentrification effect, because those people that live in there, their rents start going up because of demand. People with the higher pay package that can either afford higher rent or want to buy a property, they're buying in there and doing them up and increasing its value. So those people that are on that public housing banner, generally it sounds kind of bad, but they get pushed out over time.
Yeah, because
governments that own assets in that location, they sell them down. And then they're always buying assets in different locations to house these people. And that's kind of like that whole gentrification effect. It takes years to happen, but anyone who's listened to this knows there's locations that you grew up in where you were like, oh, we don't go there.
Yeah.
And now you're like, how the hell did someone just pay $1 million to live in that ghetto?
Stevens.
Yeah, for us it's Stevens Street
in
Varsity. I was actually looking at buying my first property there for $350,000, and if you look at that's in Stevens Street, I think it's still in the 4220 postcode.
Yeah, well, they changed it. It was Stevens as a suburb. Was it Stevens? They merged it. They just basically put Varsity, Lakes, and Burleigh, which are two different suburbs, and had them merged together over the top of this suburb that had a bad name.
Yeah,
just because it was like the.
Well, for me, even when I was back when I was a young fella, I was still looking at that and going, well...
Do you remember I got punched in the head?
Yeah.
There?
Yeah.
Through my car window?
Yeah.
Like there was a bunch of guys that, must have been like 18. I don't think we were drinking, but it was like, I don't know.
Well, you were driving. So
I was driving, yeah. It was like 15 or 20 people running after my car, throwing stuff, and then somebody punched me in the head through the car window.
Yeah, we were just having a chat, and this dude just punched him, and then someone threw a can at the window.
Yeah. And that was just being in the suburbs. So
that was the ghetto. But now,
you're buying probably like more than $1 million for a property there.
Yeah, decent one, but
so that's gentrification.
Yeah, that's gentrification, and you sort of look around it and go, well, I don't want to live there. If you're sitting there thinking I wouldn't live there. But I'd live there all the way around there because it's quite nice. I go and buy there because...
That's a good location.
Yeah.
Okay.
You just got to stack up saying, well, if I'm going to go and live there as my own occupier, I've got to live for a few years with, a little bit of ghetto-ness going around.
Yeah, a little bit of a rough street down the road.
Yeah, but you're surrounded, but you can see it because people are renovating houses around you. They're increasing that wealth. So.
That minimum local government area population is above 50,000. Days on market's good.
Yeah,
in those areas.
Vacancy rates are low.
Vacancy rates, yeah. Oh, so we haven't even touched on vacancy rates.
Oh, jeez, yeah.
Yeah, so tell us about what's a good vacancy rate?
I aim for 3% and below.
And vacancy rate is obviously rent.
Yeah. So the number of properties that are in that area that are listed for rent compared to the number of properties that are actually in it. So that if there's 100 houses in that suburb and there's 3 that are up for rent, we show a vacancy rate of 3%.
Okay.
The reason why I say 3% is that's a leading growth indicator because it's a tight vacancy rate, which generally leads to there's only 3 available houses to rent. People are trying to get in there and they're going to pay a higher rent.
The demand.
And so the demand goes up, and then often you get the shift of when rents keep going up, renters turn into owner-occupiers, and owner-occupiers are the emotional buyer, and that grows capital value. At the moment in Australia, our nationwide vacancy rate is sitting around 1.2%, so record lows. And
buy anywhere in Australia then.
And this is
just joking, guys. Just joking.
Don't do that. God damn. That's sort of the key issue in Australian politics, I feel, at the moment, is that, and why I'm so bullish on the property market, is that we're at record low vacancy rates around Australia. People are living in cars, caravans, tents, and we've had a massive supply constraint throughout this, COVID lockdown, control the people period.
And also through that, there's other things like inflation, harder for building costs, and there's a lot in that. It's a shame.
Supply levels were tough, right? And then you've got tradespeople too, where there's not enough tradies at the moment in Australia to service people's needs. So their hourly rate goes up. Obviously, if they're in high demand, you put your rates up. So that's what I'm seeing, like the underlying core issue in the market. That it's really sad to see. To be fair, like people are struggling. Then from a asset selection point of view, those that have the smarts to save enough money to get into the property market, they're going to do quite well as a result of it. So it's just unfortunately that classic case of the rich get richer and the poor get poorer. Which side of the fence do you want to be on?
Which is why we're here to educate people so they can jump onto building their own resources so they can help more people, I guess. And lifestyle by design as well. That's sort of the underlying issue that I guess you and I want to really hit home on. Is it's up to you to do something. No one's going to come and hold your hand and give you this perfect lifestyle. Get off Instagram watching bloody people do TikTok videos dancing. That's not contributing to your overall well-being. It's just you're just consuming. I could go down a rabbit hole on the toxicity of social media and content consumption, but vacancy rates below 3%. We've been through days on market, vacancy rate,
diversified employment,
population, inventory
levels,
average to high. I in my head think about the big thing, and I know we're like this is maybe not in a chronological order for everyone in terms of like what data points to touch on, but when I was looking at the properties that I would get either from you or on the other property that I purchased, development potential. What is the like? How do you find out if an area has good development potential? And what is development potential? Is that like, you mentioned a rail before, but is it like other things as well? Like, do you want high rises in the area, or do you want schools, hospitals, things like that?
Yeah, good point. So obviously we're just having a bit of a riff here, but schools is a great thing for locations. Having a good quality school and being close by, it helps to, I guess, not only in job diversification, but people are obviously needing to be educated. State schools, if they're higher performing state schools, people actually move there to get into that catchment. So they're happy to pay a higher purchase price. Sometimes there's data that proves this fact, but it's not the only thing to focus on. So it's more of just an additional layer that you look at for schools. Having hospitals as well. Generally, there's a lot of employment around hospitals, and they're safer employment levels because it's health, and regardless of what happens in the economy, that people still need doctors and nurses to look after themselves.
So that's basically. Would you classify that as government infrastructure that's already in place?
All their in Southeast Queensland at the moment, because the Commonwealth Games, the Olympic Games going through in 2032. There's a big push for infrastructure, like around road widening, heavy rail, light rail through the Gold Coast as well, to basically connect people from the public transport perspective, because it's getting so dense that driving a car around is not where they want us to be. I mean,
I'm just laughing because you try to get a park around my place. It's a nightmare.
Yeah, so and as you know, like, even people in Sydney, they often, like, there's houses that I'm buying at the moment that don't have car space.
Whoa.
Yeah, and people are paying millions of dollars for these things
without a car space.
Yep. Yeah, check out Maroubra at the moment, and like Bronte, Clovelly, like beautiful places, multi-million-dollar price tags. Some have no car spaces, and that costs about $100,000 to try and put a car space in.
Okay.
Yeah, so it's but that's just that's the norm there. And for Sydney, Melbourne, they're used to that connectivity where they can just jump on, and I mean it probably makes for a nicer lifestyle because you're not getting in the car every time to go anywhere.
Yeah, I guess.
But to each their own, obviously.
It's very very different from where we live. So I guess that's one metric as well, like public transport.
Yeah, public transport.
Yeah.
So like that's kind of getting into more like that asset selection type, which we'll cover next, which is once you find a property, once you narrow down your location, then you can jump into, well, that's sort of where my skill set is really strong, because I feel like all these data houses, I mean, they're collating all your online search interest through, say, like realestate.com. There's a company called the Demographics Group with Bernard Salt and Simon Schustermacher. Sorry if I pronounced that wrong, but really intelligent people, but they're actually tracking like where people are going in the population flows and where the trends are heading.
Cool.
So that's really key to understand, well, where are those growth prospects? And you can probably catch them on a few podcasts, or check out the website, Demographics Group. We've got no affiliation with any of these people. It's just, this is what I've learned throughout my time.
Yeah, cool. So those future, like having government infrastructure and finding out future development potential is going to move and help you understand that there's going to be capital growth, like there's capital growth prospect for that location. So what about rental appraisal? Is that a part of?
Well, it's probably getting more into
asset selection.
Yeah. But we'll jump into that. But those key areas. So making sure that the other key thing to focus on is the supply risk for that local government area, which I haven't touched on. But if you're looking into, if all your data is pointing you down to a certain location, zoom out and take that longer term mindset. Whereas if there's heaps of land supply that's surrounding that area, developers are going to come in, they're going to see opportunity, they're going to cut up those farmland and then increase the low density housing that surrounds it.
So you call this land supply?
Yeah, land supply risk. So that's looking at, how much more supply is going to come to the market over the next few years, which is going to cap your land growth, because
demand will be less because you've got more stock available.
Supplies more.
Yeah.
Demand could stay the same. Even if demand increased it, but then supply also increased, you're still going to be at that similar
growth rate.
Yeah. If it's constrained, then you're increasing your chances. So there's no guarantees in anything.
Yeah, when the government's like, yeah, we're gonna build this rail, or we're gonna do this, it's not guaranteed until work starts, really.
Yeah, well, they approve it. So they've approved all that inland rail stuff. So it's going ahead. The budget's blown out, but that's every government project. People generally go in and
it's almost every project, though, right? Like even just a renovation on your own home.
That's another good point to sort of focus in on too. Is there's a lot of government incentives, and just sit back and try to remember all the government incentives that have been pushed through in the past and how that worked out. Often it doesn't work out very well. So there's like the NRAS scheme that came through. I was working on that back in 2010. Basically, that was a national rental affordability scheme. The whole idea was to discount housing, or basically subsidise housing for investors and renters. And anyway, it led to a higher renter population and then lower demographic regions resulting, and also all those projects were house and land packages, so that people were buying these house and land packages out in the boonies or whatever, and getting really poor capital growth. So yes, they housed people for a short period of time, but they had 10-year leases on them through the NRAS, which really capped their capital growth. So that's one. There's the insulation scheme that went through that ended up costing them a lot of money. There was the insulation that was put in, ended up having like fire hazards, and now you're seeing this big solar push. Everyone go get solar.
Yeah, it's been around for a long time now.
I guess I'm going on a tangent here, but just be mindful. Even the first homeowner scheme, like people are going into these locations because they're getting that initial cash injection from the government, but they might have to buy brand new. And it's like, okay, cool. Well, you're buying brand new because you need that extra cash to get into it. However, your capital growth can be really poor compared to other areas because you're on the outskirts of a location with further land supply.
Yeah.
So you might buy that now, and then in 10 years it might grow 10%, but another location could have grown 100%.
Mm-hmm.
So just think that in mind, and that's why I talk about that land supply risk.
There was, I think our mate Parker, shout out to him, was mentioning, I don't know whether it was a conversation that you were involved in, or he was mentioning it to me, maybe on the phone, around, he had a conversation with you around if you buy a property that is out a little bit with the location, that like 1% growth rate compounds, like 1% growth rate like decrease or increase can compound either way to a massive different capital growth rate or capital appreciation or rent appreciation. Do you want to I think that you might have some maths around it. So I'd love for you to share because I don't think we've even had this conversation. So
it was basically off the top of my head. It was like a $750,000 purchase. If you had $750,000 to pay for a house, if it grew at 5% over a 10-year period, or 7% a 10-year period, it worked out to be close to $1 million in the difference in capital value.
$1 million. So from 5% growth to 7% growth, roughly. Obviously, this is going to be different between suburbs and asset and everything you buy, but on average, it could be $1 million difference between 5 to 7% over a 10-year period.
Yeah,
wow.
Yeah. That's the conversation I'm recalling it. But yeah, a 2% growth rate differential over a 10-year period for that like $750 purchase price.
Yeah,
it's compounding, right?
Yeah.
So that's what we talk about opportunity cost. I actually probably should. I've got a calculator, a compounding growth calculator that would. You can even Google compounding growth calculators, but go ahead and do it and go. Well, if I buy an asset for $750 and it compounds at 5% per year, what will the price of that be in 10 years' time? Yeah. And then do the same, but just do it at 7% growth rate, and you'll see it's hundreds of thousands, if not $1 million, in that. That's the opportunity cost that I talk about with people. So for me, I sit back and go, well, yes, you can do it by yourself. All luck to you. And that's kind of the reason why I'm like, well, there's people that want to do it themselves, and that I don't want to get in the way of that. But at the very least,
get some help.
Listen to this podcast.
Yeah.
All the people that are rattled off with those location research reports, and they specialize in that. Obviously, each buyer's agent business also specializes in that. And that's like a lot of the secret sauce from that position. But now with the increase in content and data, it's very accessible to Joe Public.
Yeah. Which is great.
Yeah, which is really good. But just
knowing what data to look at, part of why we did this podcast, but also how to analyze it. And I guess that's why we'll have to lean into due diligence and research on the right buyer's agent, or person that can help you buy the right location.
And that's the thing with buyer's agents too. Like they're looking at data and they're making a judgment call. And from what I'm seeing in the industry, I might just be more risk averse, but I came through during the GFC period valuing properties, and there was a lot of pain. There was a lot of lawsuits going around too. So I'm not in here to have a stressful life. I'm here to just enjoy the ride. But that is kind of the issue, is that there's buyer's agents that are going into locations because the data is showing short-term growth prospects. But I'm asking, what's the medium? What's the long? What happens when we do see a 4-year downturn? How's that asset going to perform? And what are your stress levels going to be?
Yeah, it's a shame that they would be so short-sighted to have good short-term growth so their client's happy for 1 to 4 years, and then they just leave them in the dark with maybe not the best location or asset.
Yeah, and we're just kind of getting into that finding the right team to work with.
Yeah.
And because what I've found is that businesses start with really good intentions, and then they grow to a point where they've got so many clients in their books that they're just it becomes more transactional. It's like,
less quality assurance
yeah,
in there.
oh, yeah, cool, we'll go up to the outskirts of Townsville, and Townsville at the moment showing really good growth prospects. However, what about all the natural disaster risks? Are you checking your floods, your fire? Also, if you are on the outskirts of that town, once again, what's the supply risk? There's so many elements to it that people need to be educated. Even if they're trusting an advisor, they need to understand that it's your money. At the end of the day, it lies on you. The property industry is unregulated, unlike the financial, like the shares and the financial planning, insurance. So get smart about it, and ask these questions.
Yeah.
And if you have any, if as we're always here, so reach out to us. Hello at
propertypals.au.
Our email. Happy to help and point you in the right direction, because it's your money, and if you get it wrong, it can cost you tens of thousands, hundreds of thousands, and if your opportunity costing over a 10-year period, sometimes millions.
Yeah, definitely.
I think we might. Want to leave that?
Yeah. Sorry?
No, you go ahead.
I would just you just wrapped it up perfectly. Really, let's cap it off there, because we do want to talk about the asset, choosing the right asset now. So stay tuned. That's the next episode coming up. But if you guys do have questions that you do want us to answer, don't just reach out for help, but reach out to ask these questions. So yeah, check out our site, and we'll see you soon.
Yeah, thanks, guys.